It was American statesman and inventor Benjamin Franklin who said, "Lend money to an enemy and you will gain him, to a friend and thou will lose him." In this lesson, we're going to read monthly payments from a table. We're going to compute monthly payments using a formula, and we're going to compute interest on loans. All to answer the question, what information do you need to know before taking out a loan? To make sure we're ready, let's do warm-up number 2 and evaluate each expression when x is 3. So 1 plus 3 is 4, and 4 to the third power is 64. 1 plus 1 over 3, 1 plus 1 over 3 is 1 1/3. Raised to the third power is 2.3 something that goes on. Second left arrow to turn that into a fraction, second the ABC button, and we get that is 64 over 27. And 3 to the third power is 27. Now let's take a look at a problem that you will be able to do by the end of this lesson. Harrison's Loan Stars loaned Nicole $900 that she needs for an unexpected car repair. She must repay the loan within 30 days. The interest is $100. What is the APR for the loan to the nearest percent? So we fill in our values. She will be paying back an additional $100 for the $900 that she borrowed. It will be borrowed for 300 days out of 365 in a year and multiplied by 100 to turn it into a percent. This means she will pay a 135% APR. Whenever you borrow money, you must sign an agreement called a promissory note, which states the conditions of the loan. Your signature is your promise to pay back the loan as outlined in the agreement. Always read the entire promissory note carefully before signing it. The loan amount you borrow is the principal. The interest rate you pay is given per year and is an annual percentage rate, or APR. The promissory note contains information that the creditor is required to state as stipulated in the Truth in Lending Act. This includes the principal, APR, monthly payment, number of payments that must be made, interest due dates for each payments, and late fees for late payments. Not all loan agreements are the same, so each promissory note describes the features of that particular loan. Become familiar with these terms. A cosigner is a person that agrees to pay back the loan if the borrower is unable to do so. People without an established credit rating often need a cosigner. Life insurance. A creditor often requires a borrower to have life insurance that will cover the loan in the event the borrower dies before the loan is paid. Prepayment privilege. This feature allows the borrower to make payments before the due date to reduce the amount of interest. Prepayment penalty. This agreement requires the borrower to pay a fee if they wish to pay back the entire loan before the due date. Wage assignment. This is a voluntary deduction from the employee's paycheck used to pay off debts. If a debtor's employer and the creditor agree, loans can be paid off using this form of electronic transfer. Wage garnishment. This is an involuntary form of wage assignment, often enforced by court order. The employer deducts the money from the employee's paycheck to pay the creditor. Balloon payment is the last monthly payment on some loans and can be much higher than the previous payments. These high payments are called balloon payments. An organization that extends loans is called a lending institution. Lending institutions are businesses that make profit by charging interest. There are many types of lending institutions, including banks, which are institutions where most customers apply for loans. Savings banks offer good interest rates but require loan applicants to have good credit ratings. Commercial banks are banks used by business, so they have large amounts of money to lend. They also require a good credit rating. Credit unions provide financial services for members only. Members may work in the same office, be in the same profession, or live in the same area. Members deposit money into the credit union account. The money is made available to members who apply for loans from the credit union, usually at a lower interest rate than a bank can offer. The rate is lower because the credit union, unlike banks, do not operate to make profit and, as a result, are exempt from certain federal and state taxes. Consumer finance companies are businesses that primarily lend money to people with poor credit ratings who cannot get a loan anywhere else. High interest rates are charged for this service. Life insurance companies make loans to their policyholders only. The amount that can be borrowed is based on the amount of life insurance purchased and the length of time the policy has been held. The interest rate is good because the life insurance company is not taking a tremendous risk, because if the loan is not paid back, it can be deducted from the life insurance benefit when it is paid. Pawn shops are known for small, quick loans. The customer who needs money leaves personal belongings called collateral with the pawnbroker in exchange for the loan. Most loans are 30, 60, or 90-day loans. When the debtor returns with the principal plus interest, the collateral is returned. Payday loan stores offer a payday loan, a small loan taken over a very short period of time, usually a few weeks or less. The borrower agrees to pay back the loan in full on the next payday. The APR is huge for these types of loans, but they are available to borrowers with poor credit ratings. Proof of employment is required for all borrowers. You may have seen loan sharks in movies. Loan sharks charge extremely high interest rates and do not formally check your credit rating. Loan sharking is illegal. Regardless of where you shop for a loan, the Equal Credit Opportunity Act requires a creditor to treat you fairly. If your application is turned down, you are protected by the Fair Credit Reporting Act, which says that the lender must give you a reason in writing for loan denial. Always compare the terms of the loan and the annual percentage rates when shopping for a loan. Monthly loan payments are computed using a formula. Payment information is often arranged in a table to make it easier for customers. Now, let's read the monthly payment from a table. What is the monthly payment for a $4,000 two-year loan with an APR of 4%? The table lists costs per $1,000 borrowed. Divide the amount you want to borrow by 1,000. Look across the table labeled 4% and down the column labeled two-year loan. The monthly cost per $1,000 borrowed is $43.42. You are borrowing 4 sets of $1,000, so the table amount must be multiplied by 4. This is going to give us $173.68 as your monthly payment. Now, let's check your understanding. Juan is borrowing $41,000 for 5 years at an APR of 3%. Using the table, find the monthly payment. So 5 years at 3% gives $17.97. This times 41 gives us $736.77. Don't forget that the table amounts are in the thousands of what is borrowed, and that's why you have to multiply it by 41. What is the total amount of the monthly payments for a $4,000 two-year loan with an APR of 4%? There are 12 months in a year, so the borrower will make 24 monthly payments in 2 years. We know from example 1 that the monthly payment is $173.68. Multiply that by the 24 payments that will be made, and you get $4,168.32. So the total 24-month payment is $4,168.32. Now, let's check our understanding of this. What is the total amount of monthly payments for a $5,300 4-year loan with an APR of 3%? 4 years at 3% has $22.13. This is per thousand, but we're borrowing 5.3 of those. That means that the payment would be $117.29. Since the loan is for 4 years and there's 12 months in a year, we would be making 48 payments. So when we multiply that by 48, we get $5,629.92. Now, let's extend our understanding. The total monthly payments for a 5-year loan is $10,692. The APR is 7%. How much money was originally borrowed? With $10,692 borrowed, for 5 years, we do know that there are 60 months in 5 years. So 10,692 divided by 60 is 178.2. This is how much is their monthly payment. We also know that for every $1,000 borrowed, they get charged $19.80. So if we were to divide that by $19.80, we get 9. Now, this is not 9. Remember, this is for every 1,000 that is borrowed. So that means that $9,000 was borrowed. Let's find the finance charge for a $4,000 2-year loan with a 4% APR. Well, back in example 2, $4,000 for a 2-year loan at 4% was borrowed, and the total payments were $4,168.32. If we subtract the $4,000 that was originally borrowed, we get $168.32 as the finance charge. Let's check our understanding of this. Carl is borrowing X dollars over a 3-year period, and the monthly payment is Y dollars. Express the finance charge algebraically. 3 years is 36 months, and so the total payment made is 36 times the Y dollars paid every single month. So 36Y, the total amount paid back, minus X, the dollars amount borrowed. Now, let's compute monthly payments using a formula. Mark bought a new car. The total amount he needs to borrow is $28,716. He plans to take out a 4-year loan with an APR of 3.12%. What is his monthly payment? The first thing we need to start with is that monthly payment formula. The principal amount being borrowed is $28,716. The rate is 0.0312, 4 years, and it is a monthly compounding. Now we fill in all of the values into the formula and we use our calculator, or we use a spreadsheet. In the command bar, you can see everything that I typed in order to be able to just calculate this. This is going to allow me in the future to just make alterations to a loan and figure out the monthly payments very quickly and easily. Now, let's check your understanding of this. Find the monthly payment for a $1,000 1-year loan at an APR of 2.5%. You can see here that I just reused an asset and went and changed the values where I needed to change them. Now this one is set up so that the number of payments per year is 12 as a default, but later on in other areas of this entire course, that'll change so that we can change the number of payments. Natasha needs to borrow $400 until her next paycheck to purchase a wedding gift. She goes to Friendly Fred's loan store. Friendly Fred's lends her the $400 for 3 weeks, at which time Natasha pays it back in full. There is no collateral required, so the APR is relatively high. Fred charges her $70 interest for the 3 weeks. What is the APR for the loan to the nearest 10%? Natasha needs to compare the payday loan APR using the formula, the amount of money paid in interest divided by the amount of money of the loan. This will be divided by the number of days of the loan divided by 365, and then everything will be multiplied by 100. So she borrows $400 and will pay $70 to borrow it. That's going to be treated as our interest. 3 weeks is 21 days out of 365 days. Multiplying it by 100 turns it into a percent, and we get 302% interest. Let's check our understanding. Harrison's Loan Stars loaned Nicole $900 that she needs for an unexpected car repair. She must repay the loan within 30 days. The interest is $100. What is the APR for the loan to the nearest percent? So we fill in our values. She will be paying back an additional $100 for the $900 that she borrowed. It will be borrowed for 300 days out of 365 in a year and multiplied by 100 to turn it into a percent. This means she will pay a 135% APR.